Oh, there's an old film, and I can't remember what it was, but it was with Joe Pesci, and he was advising some youngster. Joe Pesci was a kind of slum landlord, and he advises the youngster, there's 3 things to look for in a property. And you could see the youngster was expecting to hear the line, location, location, location. And to which Joe Pesci then said, death, destitution, or divorce.
That's good. So these things happen, don't they?
They do.
Well, it's interesting that bit, and how people pick out and discuss a neighborhood and say, well, yeah, prices might drop in the UK, they might drop 5 or 10%, but they're not going to drop here.
Yeah.
And I think, actually it was in the interview from last year, the podcast, the Pear-Shaped podcast, where Marin Somerset Webb was saying, well, that just isn't how it works. I mean, prices drop everywhere. Nowhere is, yes, I mean, one area might drop, 15%, while another area drops 20%. But no one's going to escape the bullet. No village in Wimbledon or house on the best address in London. They're all going to get hit. And it's interesting that point was made. I think yesterday they had this news about the Rick survey here. Here on Bloomberg in Hong Kong, they're talking about UK prices, and they were interviewing people and were saying, oh yes, well, London was down the most this month. And what we're finding is all those people who told us, well, London's not going to drop, they're finding that, in fact, that's not true. London's joined the party as well.
Mm. Do you know what I think the conclusion of all this is? I think we're going to have to do a year's anniversary of Pear-Shaped or Moonbound, and pick up on where we left off last year.
Yeah, I think that I'd be delighted to do that. I don't know if John will join us again, but it would be interesting to get some people on that show. Maybe. Do
you know what? I think he will.
Posters on GEI can tell us, give us some ideas of who else we can get on the show.
Yeah, well, that's a good idea. I mean, I think John will, because I think he was. I think he was he was an honest bloke, and he was a straight talking bloke, and he kind of said, and his basic premise was, if lending doesn't dry up, then the house prices won't dry up. That's what he meant when if interest rates stay low. But
yeah, I mean, I have to say, when I re-listened to that interview like yesterday, I thought we were really quite easy on him, and I was thinking, you said to him, well, I mean, he is certainly in person, and even you can hear it a little bit on his in the interview. He's a very charming guy, and he comes across as being very genuine. But I mean, he was very wrong, and it'd be interesting to see what he has to say after a year.
Have you gone back?
I mean, I think he has a problem, and he can't actually get very, very bearish because he has various clients. But
no,
there's certainly were some hints of his bearishness, and he was putting it off in the future sometime. He says, I can't rule out a crash in 2009 or something. And I think he's probably just going to tell us it came a bit earlier.
You should go back on the Money Week website. There's an article that was written by Fred Harrison in 2005 about the 18-year property cycle, and I mean, my God, the guy nailed it.
Well, here's what we have to do: we got to try and get Harrison and Wigglesworth together to see what might come out of that.
But I don't think Wigglesworth will lie. I think he'll say lending's dried up, we're mullered.
Yeah, and what's going to bring lending back? That's the thing. I mean, certainly there's nothing I can see that's going to bring it back to this 85, 90, 95% type lending we were seeing a year ago. I mean, that's madness.
Well, I was talking to Erwin Olien. I had lunch with Erwin a couple of days ago. Erwin's the CEO of Pan-African and various other junior mining companies, and he said, what's going on with your housing market? And I described the 125% loan and the 100% loan, and Erwin, in a very kind of New York accountant's kind of way, winced when I described what a 125% loan was, and then he couldn't stop laughing at how ridiculous the notion is. And like you say, all we're doing is reverting to sound lending practices.
Well, there was certainly a time that I remember, and I think we're headed back there, where the banks were they were happier to lend to owner-occupiers and less happy to lend to buy-to-let investors. And they would lend less to buy-to-let investors. And funny enough, in this crazy market we've seen, it got reversed. I'm not sure why that happened, but I guess what was happening is people were looking at their books, and they were looking at the history of the last 5 to 10 years of bull market and saying, well, I haven't lost much money on buy-to-let here, have I? I've only lost, point something %, where I've lost a little bit more on owner-occupier lending. Therefore, buy-to-let lending must be safer. Well, that was madness. And now they're going to find that they're going to have big problems in their buy-to-let portfolios, big problems. And, I can see a day when buy-to-let lending goes back to 60%. And, everyone can't get it. Now I think it's probably fairly easy to borrow still 70, maybe 75%. But, my gosh, when you start seeing a lot of foreclosures, that's going to get tightened down as well.
Well, Mike, here are the sums. I bought a place in 1994, and I bought it for £75,000. And you could rent that place out for £1,000 a month, i.e. 12 grand a year, probably a little bit more, maybe even 14 grand a year. Now, but you do the sums, 12 grand a year dividend on a 75 grand investment is what?
15% yield.
It's 15% yield. So, those are the kind of levels that we've got to go back to if we're going to repeat the 89 to 94 crash.
Well, yeah, but remember that was in a time of rising inflation and pretty high interest rates. So the yields, I don't think will go back there. But I guess the main point of that is that the yields even then were way above interest rates. And if you'd gone out and financed 100% at the prevailing interest rate, I don't know what you would have paid in terms of percent. But it wasn't 15%. It was a lot less than that. So you were actually getting a yield, a gross yield especially.
I'd say that was about double. Yeah. The yield was at least double what the interest rates were.
Well, rates got pretty high then, so maybe.
But it was. I know, but you're talking about the Black Monday and with all that when rates went over 15%. But I still think rates were below 10%. When I bought that property, rates were below 10%.
Yeah, okay, there you go. So you were getting a 5% or more cushion above and beyond interest rates, 100% loan. If you borrowed 100%, you would have paid 9% maybe, whatever, and you're getting 6% gross yield more than that. Mm-hmm. So 6% more than today's interest rate would, give you a yield of over 10%. Mm-hmm. So, wow, that's a long way to fall. That's the sort of drop.
But I don't think that's an unreasonable target.
Well, in that case, prices in that environment, we're talking about prices, getting cut in half from the top, or more. So,
or rents rising.
Yeah, our rents rising, but that's another thing. People talk about that, and I think there is in certain parts of London, upward pressure on rent. But if this recession really hits, I wonder if rents might actually go down.
I hope so.
Especially in the building you live, right?
Well, damn right. Listen, we've talked long enough, Mike. It's always a pleasure, and it's been a pleasure yet again. As we close, why don't you give out your website?
Yes, we'll have to start a thread on this. The website is www.globaledgeinvestors.com.
Good stuff. Michael Hampton, thank you very much.
My job.
Commodity Watch Radio is presented and produced by Dominic Frisby for Mindsight, with music by Manolo Camp. To discuss the markets and have your say, why not visit our bulletin board at globaledgeinvestors.com. That's globaledgeinvestors.com.